Have you come across various videos online from mortgage strategists like myself who are talking about the Smith Maneuver and rental cash damming and even non-deductible debt, and you're still super confused? That's okay. I was confused when I first heard about the concept, and it takes a lot of time to really digest it. So what I've done in this video is really broken down what those concepts mean, making very little assumptions on what your base knowledge is, and then we'll build the building blocks and show how these concepts interact in a real life example. And finally, you'll realize, is this a strategy for me now or later? And I really hope you can grasp it. So let's jump in and talk about the Smith Maneuver. The Smith Maneuver is a 100% totally legit CRA approved program. It was some dude in the 1970s. He figured it out. And what he figured out was if you borrow from your home equity in a specific way, but you borrow to invest for the purpose of generating income, the CRA will give you tax write-offs on that interest. So at the end of the year, against your income, it'll be credits so that you pay less taxes. And the government said it's totally legitimate. We want to encourage more people to be entrepreneurial and borrow to invest and grow the economy. So anyways, that's something that's been going on for years, and yet few people know about it. That's a Smith Maneuver. And before we get into the mechanics of it, now, some of you may know this. If you have a rental property, let's start with the base. If you have a rental property and you have a mortgage on it and or other expenses, you can get a write-off on that pretty much exactly like what I just explained. So the interest on your mortgage, condo fees, maintenance, that's given to your accountant. At the end of the year, the government says, oh, wow, you as an entrepreneur, because you have a rental property and tenants and it's a business, we want to give you incentive to keep maintaining that, growing the economy. We'll give you write-offs on those expenses. So you can use the expenses and credit it from your income at the end of the year. And then you get taxed, of course, at a lower amount. So that's how the rental property has always worked. So with the Smith Maneuver, it's very similar. The idea is that you are systematically taking out equity and you're doing that on another property, which is your primary residence. Now, the primary residence actually, by itself, you can't really take out equity and write it off because it's a lifestyle home. It's for you. There's no business that's certified by the CRA in that manner. So you've got tax-deductible debt on the rental property, but on the primary residence, it's not tax-deductible. So how does one make it tax-deductible? That's the Smith Maneuver. And without further ado, let's talk about the mechanic of dipping into your home equity with something called a HELOC. A HELOC is a home equity line of credit, okay? And typically you can use one only if you have at least 20% equity in your property. And the way it works is that when you pay off part of your principal on your mortgage with every payment, you open up more home equity. And as long as you have at least 20% equity or your loan does not exceed 80% of your home value based off the most current appraisal, so make sure that is done properly and in a timely manner, then you can take on equity. So the HELOC, with the right product and the right lender, again, check that with me, you can systematically, every month in an automated fashion, you can take out money. So when you take out money, again, with the intention of borrowing from your home equity to invest in bonds, stocks, ETFs, doesn't really matter. As long as the intention is borrowing to invest to generate income, you're in Smith Maneuver territory. And again, that's what Mr. Smith in the 70s came up with and realized you can finally make the equity, which is like debt equity in your primary residence, actually do something, A, make you money in the stock market if done properly, and get the tax write-off on your income at the end of the year. So that's what you do. And you just basically, you set and forget, and you are methodically borrowing to invest. The interest on the HELOC, generally it's the prime rate of Canada. Make sure to check online what that is right now. By about prime rate plus 0.25 is generally what that is. At this time of recording, it's about a 4.7, okay? So that interest that, of course, you're getting charged every month as you borrow to invest, that is credited towards your income at the end of the year. So that's a write-off and you have lower taxes. And what does that do? So now you can actually take the tax refunds to prepay your mortgage, either just to pay it off faster, or what a lot of people do, like a stock, is they reinvest these dividends or these tax credits to therefore unlock even more home equity. You take out the home equity, you borrow to invest, and it's a whole cycle. And let's call that level one, okay? So again, HELOC takes out interest, or rather takes out home equity, and the interest on the HELOC is written off at the end of the year. So that's level one of the Smith Maneuver, or as some mortgage nerds like to call it, it's the plain Jane. Let's go to the next part of this. It's called cash damming. I'm gonna call it level two of the Smith Maneuver. Okay, so if you have the luxury of having your primary residence and owning a rental property, presumably with tenants making rental income, how do these two interact? Okay, so the idea is instead of at the end of the month, when you get the rent from your tenants, and then of course you're probably paying off the mortgage and rental income, don't do that. We're gonna divert the rental income all the way to your primary residence. And just like level one or the plain Jane of the Smith Maneuver, you're gonna be unlocking more home equity by prepaying, let's say $2,000 of your primary residence mortgage. Plus, of course, with that HELOC, you're prepaying, let's say $1,000 or $500 with the principal repayments per month. And that opens up that much more HELOC, okay? That is step one. And when you do that again, remember, you can now write off more non-tax deductible debt on your primary residence. So that's sort of the first component, and you're getting the tax write-offs. Now you might be thinking, wait a second, Paul, if I didn't use the renter's rental income to pay off the mortgage on my rental property, I can't just let that be. So what do? Remember, you're dipping into your home equity on the primary residence, then you're taking that equity or money to pay off the expenses on the rental property. So there's no new cash flow here. You're just rediverting what would be rental income from your tenants. Instead of paying off your expenses, you're putting it through your primary residence, unlocking equity, then paying off the rental expenses, mortgage, maintenance, etc. So really important concept. And all the cash damming or level two of the Smith Maneuver is you're accelerating how much home equity you are unlocking and how much tax deductible debt you are opening up to get the interest write-offs at the end of the year. So if you don't understand that, press pause, go back, go through this a couple times, but very simple concept. And again, there's no new cash flow needed. It's just the mechanics and the strategy of how you move the cash flow. Now, if you go further down the rabbit hole of the Smith Maneuver, there are tons of other strategies that are using the same concept that is CRA approved, and they're just accelerating how you dip into your home equity. One's even called priming the pump. There's tons of creative, honestly, random names, but it's all around a very similar concept. So again, to put a recap on this, as you work on the Smith Maneuver, first you understand it's not for everyone. It's not a short-term strategy, getting rich quick. In fact, imagine if you did this for 2 years and you had a bunch of debt on your primary residence in the stock market dips, and now you have leveraged debt and you put it at a loss. Not good. And again, this isn't for everyone. This is a long-term strategy. And also, don't cut corners here and try to do it all by yourself. I mean, hey, you do it really carefully and you have a financial background, maybe you can do it. But about 99.9% of people, even investors and people in finance, because it's very cumbersome, they'll engage a mortgage broker like myself, the right financial advisor, and the right accountant to set up the whole system. Because if you start doing the Smith Maneuver and you don't track your bank accounts properly, it's got to be super clean and done very specifically, you're not going to get those tax refunds at the end of the year, and you've kind of wasted your time and potentially put your money at risk, right? So make sure it's done properly with the professionals. And again, if this is done properly, then over the long run, you can save up to 15 years off your mortgage, which could be hundreds of thousands of dollars. It is one of Canada's best kept secrets, but a lot of people aren't putting this into action because they don't understand it and there's too much jargon. So I hope you understand now what the Smith Maneuver is. Again, level one, we'll call it. Level two, cash damming. And you understand the concept now of making sure that your debt is tax deductible, like expenses on your rental property, but now on your primary home, which is not tax deductible, that big mortgage, portions of it through your HELOC, the interest is now tax deductible, and it's all added to your income at the end of the year. And we get taxed a lot in Canada. It gets credited to your income and you pay less taxes. And then you pay off more of your mortgage. And so the circle goes. So thanks for hanging in there today. I look forward to connecting with you and understanding how you can grow your wealth in a smart way. Talk to you soon, and thank you again for your attention. Until next time.